Hi, this is Dr. Jessica Dunn, and today we're going to be discussing stock valuation. In particular, we're going to be looking at variable growth rate models. So, most companies, constant growth is not going to be the best scenario for looking at dividend growth over time. Most companies are not large, stable, mature companies that have been in business for many, many years and have had a long track record of paying dividends with consistent growth over time. Most companies are going to go through life cycles. During their early years, growth is going to be much faster than that of the economy, and then it's going to slow. So we may see rapid increases in dividend payments or rapid declines in dividend payments. And so anytime that we see a change in the way that dividends are distributed, that causes a kink in the line. So notice, for example, this blue line. We see here that dividends were growing really, really fast, and then it slowed off. They started growing at a more consistent growth pattern. And so, like an example of this would be, is you had a really successful company. They have grown rapidly. They have tremendous sales. They have invested heavily in R&D. That's starting to pay off. So they're starting to get excess cash. So they start paying dividends all of a sudden. And those dividends, they're increasing them rapidly year over year. But at some point, they're going to level off because that company's earnings are going to become more consistent and more predictable. And once that happens, then they'll be able to just grow those dividends on a more constant basis. And so it's not always possible to use the constant growth model or the Gordon model that we've talked about previously. Sometimes it's better to use variable growth rate models, where it assumes that dividends do not grow at a constant rate forever. So here's an example. Here's a company. They have supernormal growth of 30% for year 0 to 1, 25% growth in dividends from year 1 to 2, 15% growth in dividends from year 2 to 3, and then a long run constant growth rate of 6%. Now, it's pretty standard at some point to assume that dividends are going to grow at a constant rate because you cannot accurately predict dividend patterns for several years into the future. So at some point, it's more accurate to say, okay, we predict that it's going to continue to grow, and here is the growth rate that we predict. And some years it may hit that, and some years it may not, but overall, the trend is going to average out to a specific growth rate. The required return in this example is 13%. So with variable growth rate models, the first step is to draw a timeline. Just like we learned when talking about time value of money, the first step is to draw a timeline. And so with this, time period 0 is today. From year 0 to 1, our growth rate is 30%. From year 1 to 2, our growth rate is 25%. From year 2 to 3, our growth rate is 15%. And from there on out, we expect the growth rate to be a constant 6%. So let's go to year 4 and then let the line continue. Now it says that the last dividend paid was $2. So if D0 was $2, let's calculate the dividend at time period 1. So the first step is to draw the timeline. And with that, we're going to calculate the dividends payable during the super growth period and one period beyond where it becomes constant. So here, this dividend growth rate becomes constant at year 3. At the beginning of year 3, it becomes a constant 6%. So we go ahead and calculate the dividend for time period 4. So dividend 1 is going to be equal to that last dividend paid times 1 plus the growth rate for that time period. So D0 was $2 times 1 plus the 30% growth in dividends gives us $2.60. Now from year 1 to 2, our growth rate is 25%. So dividend 2 is going to be equal to dividend 1 times 1 plus the growth rate for that period, 25%. So that's $2.60. times 1 plus 25% to give us $3.25. From year 2 to 3, we expect dividends to grow at 15%. So again, the formula is going to remain similar. We're going to calculate the dividend at time period 3, which means that we need to take the previous dividend paid and multiply it by 1 plus the growth rate for that period of 15%. And that gives us $3.74. Now, we've calculated the dividends payable during the super growth period. Now we need to go to one period beyond that, because at time period 3, the dividend starts to grow at a constant rate of 6% forever. And so we need to calculate dividend 4, which is the previous dividend times 1 plus the growth rate for that period, 6%. And that's $3.96. So we've calculated our dividends payable. Now, the reason why we are not having to calculate any dividends beyond time period 4 is that beginning at time period 4, we are able to use the Gordon model that we learned in previous lessons. So we're able to collect from the constant growth model that at time period 4, we know the formula that allows us to calculate that value, because dividends are growing at a constant rate forever, which is the definition of the constant growth rate model. So with that, one thing to keep in mind, the rule with this is that we only use each dividend once. So we calculated each of these dividends, and we're only going to use them one time in calculations. And that sometimes helps students decide where to put the numbers. So step 1 was to create your timeline. Step 2 is to employ the use of the constant growth rate model. And the constant growth model says that whenever the dividend becomes constant, and it becomes constant at the beginning of year 3, from year 3 to year 4 is that constant 6%. So it becomes constant at year 3. So we'll find the price at time period 3 would be equal to the next dividend payable, dividend 4, divide that by the required return minus the constant growth rate. So this is all things that we've done before. Remember, the formula for constant growth rate was the price today is equal to the next dividend you would receive divided by the required return minus the growth rate. And this was the constant growth rate model. So the price today is equal to the dividend in the next period. So dividend 4, we calculated that as $3.96. Divide that by the required return of 13% given to you in the problem, and subtract from that our constant growth rate of 6%. So $3.96 divided by 13% minus 6%. So let's plug this into our calculators. $3.96, divide that by 7%. And we get $56.50. So the value of this stock at time period 3 is $56.57. Okay, now the rule is that we only use each dividend once. So we're not going to have to use dividend 4 anymore in calculations. Another way to think about that is the value at time period 3. Remember, that's the present value of all future benefits. So in the case of stock, it's the present value of all future dividends. So once you've calculated the value at year 3, you don't have to worry about anything that happens after that. But if you just want a nice simple rule, we only use dividends once. So we use dividend 4 and the calculation for the constant growth rate model, and so we're not going to use it again. Okay, so now it looks like a regular problem, like one we've done before. Now we have a series of cash flows on a timeline. We have dividend 1, dividend 2, dividend 3, and the price at time period 3. So you can use your cash flow register, which we did back when we were talking about time value of money. Our cash flow at time period 0 is equal to 0. There's nothing that happens at time period 0. We always assume that D0 has already been paid. So you push enter in the down arrow. Our cash flow at time period 1 is equal to dividend 1, $2.60. Now the frequency of that is 1 because that $2.60 occurs once. Cash flow at time period 2 is equal to dividend 2, $3.25, and that occurs once. Cash flow at time period 3 is a little bit different because we have the dividend that we're going to receive, plus we have the price of the stock because that incorporates all future dividends. So we have to take dividend 3 and add to it the price at time period 3, so $3.74 plus $56.57. And the frequency of that is 1. So now we need to plug this into our financial calculator. Okay, so to do this, we push the cash flow button, which is right next to the second button. So cash flow at time period 0 is 0, so we just scroll down. Cash flow at time period 1 is $2.60, so we enter that in, and to save it, we have to push enter. Once we push enter, you see that the equal sign appears, so it's saved. Scroll down, the frequency is 1, which is the default. Cash flow at time period 2 is dividend 2 of $3.25. Again, you have to push enter to save that. Cash flow at time period 3 is $3.74 plus $56.57 for a total of $60.31. Enter to save it. Then we use a net present value function because we're wanting to take the present value of all of these dividends. Our discount rate is the required return of 13%. So 13, notice there's no equal sign, so we do have to push enter, down, and compute. And we get $46.64. So NPV, be your next button. Your discount rate is equal to that 13%. Enter, down, and compute. And we get $46.64 as the value of this stock today. When we talked about the constant growth rate model, we discussed how the total return of the stock was equal to the dividend yield plus the capital gains yield. And we had said that the capital gains yield was equal to the constant growth rate. Here we no longer have a constant growth rate until we get to year 3. So until then, our dividend yield and our capital gains yield are not going to be constant. So let's go ahead and calculate our dividend yield at time period 0. So at time period 0, our dividend yield would be equal to the next dividend we would receive, so that dividend 1, divided by the current price of our stock. So our next dividend, D1, was $2.60. The price of our stock today was $46.64. So let's do that on our calculators. And we get 5.6% rounded. Our capital gains yield then, capital gains yield, would be equal to our total return, that required return, minus our dividend yield. So that was, our required return was 13%, which was given to you in the problem. Subtract from that our dividend yield of 5.6%, and you get our capital gains yield of 7.4%. Because remember, total return, which in an efficient market should equal your required return, is equal to your capital gains yield plus your dividend yield. So during non-constant growth rate times, the dividend yield and the capital gains yield are not constant. If current growth is greater than our constant growth rate, then our current capital gains yield will be greater than our constant growth rate. So after time period 3, you notice that we assumed that our growth rate became constant at 6%. So at that point, our capital gains yield would equal 6%. And our dividend yield would be 7% because our required return is 13%. So steps for non-constant growth. First, we estimate the expected dividends for each year during the period of non-constant growth. Then we find the price of the stock at the end of the non-constant growth rate period. So that forces us to calculate the dividends for the non-constant growth rate period plus one period after. Step 2 asks us to use the Gordon model to find the value of the stock at the end of the non-constant growth rate period. Then finally, we find the present value of these dividends and the price of the stock using the cash flow worksheet on our calculator and the net present value function. Alternatively, if you didn't want to use your cash flow worksheet button, you could take the present value of each of these dividends individually and the present value of this price and add them up. You'll still get 46.64. The cash flow worksheet option is just a nice little shortcut. But let us ask a different question. Is the stock price based on this short-term growth? So we see this exponential growth here in the first 3 years. Is that what's driving our stock price today? We found that the current stock price is $46.64. And we found that the present value of all the dividends beyond year 3 was $39.22. And we see that from our calculations with the timeline. So the percentage of the stock price due to long-term dividends would be that 39.22 divided by the 46.64. And that gives us 84%. So most of our stock price is not because of these short-term growth rates. It's due to the long-term growth rates beyond year 3. So let's do another one. Let's suppose that the growth rate is 0 for years 1 through 3, and then it becomes a constant 6%. So the same problem, remember our dividend was $2, so our last dividend paid was $2, and our required return is 13%. So let's draw our timeline again. So here we are today, and we see that from year 0 to year 1, our growth rate is 0. From year 1 to year 2, our growth rate is 0. And from year 2 to year 3, our growth rate is 0. So we're not going to increase dividends at all. But beginning in year 3, we're going to start growing our dividends at 6%. So first rule is to calculate our dividends to one period beyond where they become constant. So let's go ahead and calculate D1, D2, D3, and D4. Now the calculations here are really simple because they're not growing. The dividend's going to be the same. Our dividend is $2. At time period 4, we need to take our last dividend and multiply it by 1 plus the growth rate. So here that's $2 times 1 plus 6%, so $2.12. And here that growth rate is the 6%. So now step 2 is to calculate the price at time period 3, because year 3 is where this growth rate becomes constant, and we can utilize the constant growth model. So the price at time period 3 is equal to the dividend in time period 4 divided by the required return minus the constant growth rate. So $2.12 divided by 13% minus 6%. So 212 divided by 7% is $30.29. Now we've used that dividend 4, so we don't have to use it ever again. We don't have to worry about anything past time period 3 because we have the price at time period 3, which is the present value of all future dividends. Now we can utilize our cash flow methodology. So step 3, we're going to use our cash flow worksheet. Cash flow at time period 0 is 0. Cash flow at time period 1 is 2. The frequency of that cash flow, we could use that if we wanted to, or we can skip it. So you could say that it had a frequency of 2 because the third cash flow is going to be the sum of these. But I'm just going to skip it for now. Cash flow at time period 2 is dividend 2, which is $2. No reason to create any confusion if it's not necessary. Cash flow at time period 3 is the dividend at time period 3 plus that price at time period 3. So we have $2 plus $30.29. So let's go ahead and utilize the cash flow function in our calculators. So with the cash flow function, once you push the cash flow button, it won't clear out if you just push the clear button. You have to push the cash flow button and then use second clear work to make it empty. So now you can scroll through it and you'll see that it's empty. So our cash flow at time period 0 was 0 because we always assume that the last dividend was paid, and that would not affect current price. Cash flow 1 is $2, dividend 1, the frequency of 1. Cash flow 2 is dividend 2, which is $2. So enter, down, frequency of 1. And cash flow at 3 is the $2 plus the $30.29. Save that. Now I'm going to utilize the net present value function, which asks us what our discount rate is, and that's our required return, so 13%, enter. And it is a function in our financial calculator, so this is whole number interest rates. Scroll down and push the compute button, and we get $25.71. So we use the NPV button. Our I is that required return of 13%, and we get $25.71 as the value of this stock today. So let's go ahead and calculate our dividend yield and our capital gains yield. So remember, our dividend yield is equal to the next dividend you would receive divided by the current price. And we said the current price was $25.71. So dividend 1 was $2. Divide that by our current price. $22. I'm sorry, I wrote that wrong. $25.71 for a dividend yield of 7.8%. So now we can calculate our capital gains yield. Our capital gains yield is going to be equal to our required return minus our dividend yield of 7.8% for a capital gains yield of 5.2%. After time period 3, we have constant growth. So we know at that point that our capital gains yield is going to be equal to our constant growth of 6%, which would mean that our dividend yield would be equal to our required return minus our capital gains yield, so 7%. And that's the way it will be forever after year 3 if dividends remain constant. Now let's see what happens if a stock has a negative growth rate. Would anyone buy that stock? So the short answer is yes. Even if dividends are declining, the stock does have value. So if the growth rate is a negative 6%, the constant growth rate were a negative 6%, let's just calculate this assuming that this is the constant growth rate forever. So we can utilize the Gordon model. The Gordon model says that the price today is equal to the next dividend you would receive divided by the required return minus the growth rate. The last dividend we receive is $2 and the required return is 13%. So we first need to calculate D1. D1 would be equal to D0 times 1 plus the growth rate. So that's $2 times 1 plus a negative 6%, so 1 minus 6%, or 94%, and that gives us $1.88. So let's calculate the price of this stock today, and here we're not messing with any of the variable growth rate, we're just saying it has a negative 6% growth rate from day 1. So the price of this stock is equal to $1.88 divided by the required return of 13% minus a negative growth rate of 6%. So subtracting a negative is the same thing as adding a positive. So it's $1.88 divided by 0.19. That gives us $9.89. So yes, the stock still has value. In this instance, the capital gains yield would be a negative 6%, which would mean that the dividend yield would have to be a positive 19%. And so the high dividend yield would offset the negative capital gains yield. So even though the stock price is declining, it's paying a very high portion of its earnings as dividends.